Welcome back to Investing Talk Podcast.
Today we're looking at Applovin.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us, and we appreciate every single one of you tuning in.
So we need to talk about what might be the single most confusing stock in the market right now.
Okay.
We are looking at a company sitting at the dead center intersection of, high margin ad tech and real actual AI implementation. Applovin just reported their Q4 2025 earnings, and the reaction is, well, it's volatile.
Volatile is a very polite way of putting it. I'm looking at the screen right now, and this whole setup is it's giving me whiplash.
Right.
You have a company that absolutely crushed its profitability numbers. I mean, they beat earnings estimates by a mile. But then you look at the after-hours trading.
It's dropping.
The stock is bleeding out.
Yeah.
It's screaming trap.
It's a massive disconnect, plain and simple.
But that's the mystery we have to solve today, isn't it? Is the market just having an irrational panic attack? Or is there a red flag buried deep in the guidance that the algos are spotting, but retail investors are missing?
That's the multi-billion-dollar question.
Because usually when a stock drops on good news, there's a skeleton in the closet somewhere.
I honestly don't think it's a skeleton. I think it's a fundamental misunderstanding of their moat.
Their moat.
They have this AI engine called Axon 2.0. And I know, everyone and their grandmother says they have AI now. It's the buzzword of the decade.
Right.
But this thing is actually printing cash. And they've completely pivoted the company, dumping their gaming assets to focus purely on software margins.
Okay, printing cash is a bold claim for a stock that's in the red after hours.
Right.
So let's stop teasing it and actually look at the evidence.
Let's do it.
Let's unpack the numbers, because that's where the truth usually hides.
Absolutely. Let's get into the fundamentals.
All right, I've got the Q4 2025 numbers right here. Top-line revenue came in at $1.66 billion. Now, in a vacuum, $1 billion-plus quarter is great. But in the market, expectations are everything. The analyst estimate was $1.70 billion. So technically, this is a miss.
It is a slight miss on the top line, I'll grant you that.
Definitely.
But if you fixate on that one number, you are missing the forest for the trees.
How so?
The story here isn't just about how much money came in the door, it's about how much they kept. The story is profitability.
Yeah.
Earnings per share, the EPS, hit $3.24.
Which is good.
It's massive. For context, the consensus on Wall Street, what the smart money expected, was only $2.95.
So they beat by a lot.
They beat expectations by over 12%. In the world of mature software companies, a 12% beat on the bottom line is practically unheard of. This isn't a shrinking business. It's a business that has become hyper-efficient.
Okay, I see the EPS beat. And looking at the historical data, the revenue surprise is actually up 2.88% relative to some metrics, so it's not a total disaster.
Yeah.
But then we have the forward guidance.
The growth.
They were indicating a 52% growth trajectory. That feels aggressive for a company this big, doesn't it? Usually gravity starts to pull you down at this scale.
It is aggressive. That's the kind of growth you usually see in, small cap startups, not multi-billion-dollar companies. But the reason they can hit those numbers is that strategic pivot you mentioned, the divestiture.
Right. They sold off the gaming assets, unloaded their studios for $400 million.
Right.
Now, let me play devil's advocate here. Why do that? Those assets were generating cash.
They were.
So why sell off a known quantity to bet the farm on ad tech?
Focus. Pure and simple focus. Think about the business model of a gaming studio. It's hit or miss. You spend millions on a game and maybe it flops. It's risky.
It's like Hollywood. You're only as good as your last hit.
Exactly. But providing the software that runs the ads for everyone else's games, that is a gold mine. You aren't betting on one horse. You own the racetrack.
So selling the shovels instead of digging for gold.
Precisely. And the margins prove it. If you look back at Q1 2025, the advertising segment's adjusted EBITDA grew 92%.
Okay, let's pause for the listener who isn't a CPA. Adjusted EBITDA, we throw that around a lot. What is it, basically?
Sure. Think of it as the raw cash flow the business generates from its operations before, accountants and taxes and interest payments get involved. It's a measure of pure operating health.
Got it. Pure health.
And that segment grew 92%. At an 81% margin.
81%. That is sauce territory. That's printing money territory.
Yeah, that is why they sold the games. They want to be the infrastructure of the entire mobile economy.
And that infrastructure is built on this Axon 2.0 engine. Now, be honest with me. Is this actually a proprietary tech, or is it just a wrapper around someone else's model?
No, this is the real deal, and here's the key insight. It's about contextual data. Axon is processing data across 1.4 billion daily active users.
1.4 billion, that's approaching meta scale.
It is massive, across 2 million apps. But here's the aha moment. Ever since Apple changed their privacy rules, advertisers have been flying blind. They can't track you across the web anymore.
Right, the Ask App Not to Trap button we all press.
Exactly. That killed the old way of advertising. But Applovin doesn't need to track you across the web.
Because they're already inside the apps.
We are inside the apps. They see what you're doing in there. They see you play a game, how long you play, if you make a purchase. Axon uses that context to predict who is likely to download another game or buy a shirt.
So it's privacy safe, but still effective.
And that creates the flywheel effect.
Break that down.
It's a classic data flywheel. The more data Axon processes, the better its predictions become.
Which means a higher ROI for advertisers.
Who then spend more money, which attracts more apps, which brings more data, and the cycle repeats. They've solidified themselves as the global number 2 in this specific ecosystem.
Wait, number 2? Who's number 1?
Well, Google and Meta are obviously the titans, but in the mobile app world, Applovin is a very strong number 3, and in some areas, they're winning. Here's a stat that blew my mind. They're currently seeing 38% more e-commerce ad spend growth than TikTok.
Hold on. More than TikTok. But TikTok Shop is all anyone is talking about right now.
Applovin is beating them in growth of ad spend in that vertical. Their targeting, driven by Axon, just converts better.
That is genuinely impressive. And they're serving over $10 billion in annual media spend.
The scale is there.
So a profitable, growing company with a huge moat, which brings us back to the crime scene on the charts.
Let's pivot to the charts. Let's see what the market is actually doing.
It is not pretty. If everything is so sunny, why does this stock chart look like a red cliff? Shares are down nearly 3% in after-hours trading. To the untrained eye, this just looks like a sell-off.
It looks like that, sure. But I would reframe this. I think what we're looking at is a classic capitulation low.
Capitulation. That's a trader's term for puking. Right. Explain that.
It's when the last of the weak hands sell out. You have traders who were gambling on a massive revenue beat. They wanted a quick pop.
And they didn't get it.
So they dumped the stock. But the fundamentals, the earnings, the margins are incredibly strong. When price drops but the business gets better, that is often a psychological trap.
So the tourists are leaving and the investors are staying.
Exactly. The stock consolidates, shakes them out, and then reverses.
I see the logic, but what about momentum? The drop is tied to that revenue miss. Big institutional funds hate uncertainty. Are they really going to step in here?
Well, that uncertainty creates what we call a momentum coil. The sentiment right now is fearful, right?
Clearly.
That fear is masking the underlying strength. It's like holding a beach ball underwater. The market is holding the price down, but the buoyancy of that 52% growth is pushing up. Eventually, the ball pops.
And we should note, Applovin is a leader among earnings movers right now. The volume is high. People are watching.
High volume on a dip is often a sign of accumulation by smarter money.
Okay, well, let's see what the broader market is actually feeling. Let's shift gears to the sentiment analysis.
Let's check the market pulse.
I pulled the quantitative sentiment score for Applovin just before we started. It is sitting at a flat neutral, a 0.
Which makes perfect sense.
Does it? For a growth company, usually you want extreme greed or extreme fear. Neutral just feels indifferent.
I don't think it's indifference. I think it's a tug of war.
Explain that.
You have the good pulling one way, the profitability, the AI narrative, and you have the bad pulling the other way, the selling, the revenue miss. The market is paralyzed. It doesn't know which narrative to believe yet.
So it's a narrative battle.
Exactly. And the analyst chatter reflects that. They're mixed to bullish on the fundamentals, but bearish on the short-term chart.
They love the business, hate the stock price.
But look at what they're highlighting. They're pointing to double-digit revenue jumps. They're talking about the expansion into connected TV, CTV, and e-commerce.
Connected TV is a huge market.
It's a $50 billion total addressable market that Applovin is moving into.
A $50 billion playground to grow into.
Right.
True. But I'm looking for the upgrades. I haven't seen specific 2025 analyst upgrades hitting the wire yet. Where are they?
Give it 24 hours. A 12% EPS beat is hard to ignore. The upgrades will follow the math.
Fair point. But my job is to worry. So let's take off the rose-colored glasses. What could actually go wrong here? That revenue miss didn't happen by accident.
All right, hit me with the bear case.
It starts with that top line. $1.66 billion versus $1.7 billion. You can wave it away, but in a growth stock priced for perfection, any miss is punished.
I acknowledge that. And the guidance, while forecasting 52% growth, is technically a slowdown from their old hyper-growth periods. The law of large numbers kicks in.
Exactly. And this signals that advertising competition is heating up. If the economy slows down, ad spend is the first thing to get cut, right?
It is. That's a valid macro risk. But there's a bigger risk you're hinting at.
The elephant in the room. AI disruption.
The Google is going to kill everyone argument.
Well, it's a valid fear. Google and Meta have virtually infinite resources. They're building their own AI. Is Axon 2.0 really going to survive if Google sneezes?
That is the ultimate fear. But here's the counter-argument from the CEO. Advanced models actually benefit Axon.
How? Better AI from Google should hurt them.
No, because Axon just feeds on data. Better foundational models just make processing that data more efficient. And remember, advertisers are paranoid.
Paranoid about what?
About being totally dependent on Google and Meta. They hate the duopoly. They do not want to be beholden to two companies for their entire business.
They need a third option.
They need a third viable option to keep costs down. Applovin provides that check and balance. Being the Switzerland of the ad economy is a massive strategic position.
So the bull case relies on them being the essential alternative.
The essential high-margin alternative.
Okay, we've looked at the numbers, the ugly chart, and the risks. Let's bring this home.
Let's move to the verdict.
So, give me the elevator pitch. Why should someone care about a stock that just missed revenue?
Because you aren't buying the last 3 months, you are buying the next 3 years. Applovin has transformed into an 81% margin business. They're expanding into a $50 billion market. And the data shows they are outpacing rivals like TikTok. They are winning where it counts profitability.
And from a trading perspective, I have to agree that the post-earnings dip looks enticing. When you see a company generating this much free cash flow and the stock drops 3% on a knee-jerk reaction, that usually looks like an entry point.
It's a discount on future growth.
So put a number on it. What's the score?
I am giving this a bullish score of 8/10.
An 8. That is confident.
It is. The fundamentals are too strong to ignore.
And what's the horizon here? Are we day trading this?
I see 2 plays. You can play the swing trade into Q1 earnings, which would be late April or May 2026 to catch the reversal. Or you hold this for a multi-year horizon and the mode expansion.
So buy the dip, ride the AI wave.
Exactly. My final verdict is buy the AI-fueled upside while the market is scared of a small revenue miss. The fear is temporary. The cash flow is permanent.
A compelling case. I'm still keeping a wary eye on that revenue line, but the profitability is undeniable.
The numbers don't lie.
All right, that's a wrap on Applovin. A fascinating setup for sure. Make sure to subscribe, like, and comment to support the show. We'll see you in the next one.